So myth number one is that nonprofit accounting is completely different than for-profit accounting. There's this idea, and that's a myth. And the fact is that substantially most of it is the same. Most of it is the same. I know because I do my own accounting for my business and I do accounting for nonprofits. Yes, there are some key differences, but most of it's the same, right? And I think that this myth is difficult for many people to understand because substantially most of it is the same. So understanding what are the similarities and then understanding the key differences, right? So those key differences really fall into two different categories. Tracking of revenue, the nonprofit world does it much differently, and ownership and how we categorize ownership, right? So let's go back to revenue. So in the for-profit world, most for-profit businesses, especially small businesses, it would be of similar size to many of you listening out there in the nonprofit world, let's say less than 10 million. These are considered small businesses in the grand scheme of things. And on the for-profit side, most of these small businesses are going to be functioning in a cash basis, which means they don't record revenue until it's deposited in their bank account. And they don't record expenses until it leaves their bank account, right? In, out, very simple, right? While the nonprofit world, even if we're considered small, less than 10 million, most of us are going to be subject to an audit. Most of our funders want to see us operate in an accrual basis accounting, which means we have to record things when they are earned or when they're promised to us. So I'm talking about those pledges, I'm talking about those grants receivable, or those multi-year gifts, maybe a capital campaign or something like that. That all has to be recorded, even though we haven't actually received the money, right? So that's one difference on the revenue side is the timing, not just for the accounting rules for specific to nonprofits, something like a pledge or a gift, right? For-profit businesses don't typically get people that want to gift them money. They have to sell something, right? The nonprofit world does. And then there's also the fact that not only are you a nonprofit and you have to record pledges based on when they are pledged to you, not received, but when they are promised to you, that's the difference with the for-profit world. And you also have to operate on an accrual basis, typically, not always. It depends on if you get audited or if your funders require that. But most nonprofits, once they reach, over $1 million, they start to convert from cash basis to accrual basis. So revenue is the biggest thing. So tracking the revenue, not just how you record it and when you record it, but tracking the revenue, right? In the for-profit world, if I have 200 clients and they all pay me a retainer, I don't have to keep track of how I spent this client's retainer versus that client's retainer, or maybe how I spent money for our monthly accounting services versus how I spent money on revenue that we generated from filing tax returns or something like this. No one cares, right? No one has to keep track of it in that way. As you all know, in the nonprofit world, we do have to keep track of certain dollars, especially if they are restricted, right? That does not exist in the nonprofit world. So we have to kind of create these little funds and be accountable for how we spend the money. So that's different in the timing of when we record the gifts, or the revenue, I should say, not even just gifts. The timing and when we have to record revenue. Most for-profit businesses, small businesses, if you were to compare similar size, are going to record it when the cash is received. Nonprofits can't really get away with that, especially if they're audited. That's going to come up under audit. Now, I will say most for-profit businesses, once they reach to a certain size, if they get audited, they have to switch to a similar model than the nonprofit. They have to start recording things when they're earned, not necessarily when they're received. And certainly very large corporations typically do their accounting on an accrual basis. Why is this the difference for the for-profit versus nonprofit in this smaller space? Frankly, a lot of it is the IRS assesses taxes based on a cash basis for small businesses, right? So I don't pay taxes unless I collect revenue. So because for-profit businesses are trying to understand their tax liability at the end of the year, they do their accounting on a cash basis because that's basically what the IRS looks at for small businesses. That's really the fundamental difference in why they do that. There is a method to that. Okay, so that's revenue. I don't want to get too much into the weeds. Nobody likes listening to all this accounting jargon anyway. The next big difference is ownership, right? In the for-profit world, there is a clear ownership. Every business has to have an ownership structure, whether it's one person, multiple people, stock, maybe it's many, many people, right? In the nonprofit world, there is no ownership, and we'll talk a little bit about that later. But really what it's called in the for-profit world, it's equity. retained earnings, something like this. In the nonprofit world, it's called net assets, right? And these net assets are kept track of, okay, what is all of the surpluses or the profits that have accumulated? That's what equity is, or net assets, an accumulation of any excess surpluses or deficits. It's the summation, it's the total of that over time since inception. So add the surplus or deficit for year 1, year 2, year 3, et cetera, all the way up to the current day. And it tells you overall, since inception, have you been operating at a deficit, because that number will be negative, or a surplus, that number will be a positive. The nonprofit world is a little more complicated, as they like to narrow that down to, are any of those surpluses that are left over, let's assume surpluses, think positive today, are there any strings attached to that? These are the restrictions. So when you have net assets with restrictions, right? For example, say over time you had a capital campaign and you have $50,000 left that you need to spend. That should show up in your net assets that, yes, we have a $200,000 in net assets, but 50,000 of that is earmarked towards capital campaign. In the for-profit world, they don't have that. Whatever you collect, whatever you earn, the business owner can do whatever they want with it, for the most part, assuming you haven't taken on loans or something like this, and you're, I'm talking earned revenue. I'm not talking about borrowing money from the bank. They might have some issues with what you do with that money, but for all intents and purposes, earned money in for-profit world can do whatever they want. Nonprofit world, they not only can't do whatever they want, they have to track it and they have to report on it. So all of these things show up in the financial reports. And that's the biggest difference. I mean, really, I like to say 80-90% of it is the same. There are just a few key differences, and it's going to show up in revenue and it's going to show up in the equity primarily.